Hello, everyone. If the market feels confusing, maybe even a little uncomfortable right now, trust me, you are not alone. A lot of investors are feeling pretty frustrated. So, in today's explainer, we're going to provide a really clear analytical framework to help cut through all that noise and understand what's really going on. Let's get started. This quote just nails the heart of our discussion today. That discomfort you might be feeling, it isn't just random noise. It can be a really powerful signal. We're going to explore how this exact period of pain could be setting the stage for the next big wave of opportunity.
So to get to the bottom of this, here's how we're going to break it down. We'll start by dissecting the market's painful transition. Then we'll uncover a tale of two very different sectors. After that, we'll dig into the re-rating of public sector undertakings, map out the global risks that we just can't ignore, and finally, show you how today's pessimism could actually be tomorrow's biggest opportunity. So, first things first, let's define what this current market behavior is actually telling us, because it's probably not what you think. Right now, we're in what you could call a slow transition phase. And what that means is instead of panicking or blindly chasing hot stocks, investors are getting much more cautious. They're quietly moving towards safer areas of the market and deliberately avoiding any unnecessary risk.
And here is the most crucial point, okay? What we're seeing is a strategic market repositioning, not a collapse. And that distinction, well, it's everything. It's a deliberate shift in strategy, not an outright crisis. Now, this repositioning is creating a really fascinating split in the market. It's truly becoming a tale of two very, very different sectors.
You can see the market is really splitting into two distinct camps. On one side, you have the IT sector, which is grappling with some major headwinds and a lot of uncertainty. But on the other side, public sector, or PSU, companies are showing this quiet, steady improvement and resilience.
So if we dive into the IT sector, there are really three big challenges. First off, AI disruption is shaking up the traditional outsourcing models we've known for years. Second is what some people are calling the Claude effect, this idea that powerful generative AI platforms are so good, they're fundamentally changing the demand for traditional software services, which is creating this fog of uncertainty. And third, large overseas funds, what we call foreign institutional investors, they're pulling back and reducing their exposure, which is a big sign that confidence is going to take some time to rebuild. Now, contrast that with the PSU sector. In the Central Public Sector Enterprises Index, or CPSE Index, over 60% of its entire weight is in energy and power. And in that space, electricity demand is growing at a rapid 6 to 6.5% a year. This directly benefits the major players, companies like NTPC and PowerGrid. And on top of that, there's a new dividend policy that mandates payouts, which makes these companies way more attractive to investors who are looking for stable cash flows.
Okay, so this brings us to a really crucial development. The fundamental reevaluation of these PSU companies, and it's all being driven by some significant policy and structural changes. Let's break that down.
At the very core of this whole shift are the 2024 dividend norms. So what does that actually mean? Well, this policy basically forces these companies to distribute consistent and predictable returns. It turns them into reliable dividend payers. And for investors who really value stable income, that change is an absolute game changer.
But it goes even deeper than that. There's a proposal from the Economic Survey suggesting the government could reduce its stake to just 26% while still retaining control. Now, that would open the door for much better corporate governance and efficiency. Then, when you combine that with massive infrastructure spending, well, the long-term outlook starts to look very, very different.
And look, this isn't just talk. We're looking at real concrete numbers. Take this, for example, 9.15 lakh crore. That's the planned investment just for power transmission expansion. This isn't some forecast. It's tangible spending that flows directly to the companies that are building out this infrastructure. Of course, while there are these pockets of strength, we can't just ignore the external threats. We need a really clear-eyed view of the geopolitical factors that are at play right now. A perfect example is the ongoing conflict in the Middle East. It sets off this predictable chain reaction, right? The conflict causes oil prices to rise, which then increases inflation. This forces central banks to react, usually by keeping interest rates high, which in turn leads to greater market volatility. And for an energy-importing country like India, this sequence is a critical risk factor that can impact everything from corporate profits to overall market sentiment. All right, now for the pivot. With all this uncertainty, how do we find an edge? Let's look at a key piece of data that offers a surprising counter-narrative to all this pessimism. So right now, only about 25% of stocks are trading above their 200-day exponential moving average. Now, at first glance, that number looks terrible. It signals widespread weakness across the market. But what does it really mean? Okay, so just so we're all on the same page, what is the 200-day EMA? Well, think of it like a key technical indicator that helps gauge the long-term health of a stock. When a stock is trading above this line, it's generally considered to be in a healthy upward trend. So here's where things get really, really interesting when you look at the historical context. Whenever the percentage of stocks above their 200-day EMA falls below 30%, it has historically signaled a moment of extreme pessimism. And here's the counterintuitive part. Historically, these moments of maximum fear have often happened right near major market bottoms, signaling what has often been the point of maximum long-term opportunity. You know, there's an old saying that the market first makes people suffer, and then it rewards those who are patient. We are clearly in the suffering phase right now, especially if you're invested in small and micro caps. But history tells us this is a normal part of the cycle that ultimately creates the best entry points. So the big question becomes, in an environment like this, where are the hidden opportunities? Well, the answer often lies in looking just beyond the obvious popular themes to find the supporting players. Let's take the copper theme as a perfect example. A year ago, everyone was focused on the big copper producers. That was the obvious play. But the real hidden opportunity was one layer deeper, in the supporting businesses, like the companies that simply make copper wires. The lesson here is that the biggest winners aren't always front and center. They're often the ones enabling the main trend. So let's bring it all together with this final thought. AI disruption, geopolitical risks, market volatility, all of this feels deeply uncomfortable, I get it. But real opportunities aren't found when investing feels easy and comfortable. They're found when it feels uncomfortable, but the underlying logic and data suggest it's a time for preparation, not for panic. So I'll leave you with this. The market is painful, yes, but history shows that the next big opportunity is almost always born in moments exactly like this one. The real question isn't whether it will come, but rather, are you prepared to do the hard work and study it?